Hello, traders, and welcome to a new episode of Beyond the Charts. Last week we had some news releases finally after the government reopened. We saw the release of the NFP number and the unemployment number, so the labor market numbers. But you should note that those numbers are not coming from October, they're coming from September. So those are the numbers available because now officially the numbers of October are lost forever. We will never see the NFP numbers, the labor's market numbers, and the inflation numbers coming from October. And that's the first time since 2013 that this has happened. So it's officially cancelled. The numbers from October are lost forever. Now, let's get to it and go through the weekly high impact news calendar and go day by day and see how each news release impacted the markets. So, let's get to it. First of all, we had Monday. On Monday, we had the quarterly GDP coming from Japan. The previous was 0.6%. The forecast was minus 0.6%, so a contraction. And the actual came less bad, but still bad, at minus 0.4%. So, what does that mean? It means that the Japanese economy is contracting. It's in a bad shape, but it was expected to contract by 0.6%. It contracted less, so 0.4%. But it's still bad. It's still a contraction. So we saw the reaction on the JPY or the USD JPY. JPY weakened against the dollar, and we're seeing weaker and weaker JPY by the day. Now, how did that impact other things? The gold stayed flat, the Nikkei gained 0.3%, and there was a mild US lift after this release, so 0.1% on the S&P. But that's it. Nothing more than that after this release. So that's it for Monday. Let's move now to Tuesday. Tuesday, we had the initial jobless claims. So the previous reading was 219,000 jobless claims. The forecast was an increase in that number, so at 223,000. But the actual came in higher than both at 232,000 jobless claims. So it was worse than both the forecast and the previous. So what does that mean? Obviously higher than expected, and it means that layoffs ticked up slightly, signaling the labor market softening, but it's still low historically. And it gave a pre-NFP cautionary note. Okay, so how did that impact the market? The S&P lost 0.2% intraday on jobs worry. The gold gained 0.2% as downturn hedge. And the FX majors, mainly talking about the USD, it lost 0.1%, while the Euro USD gained 0.1%. GBP USD stayed flat, while USD JPY lost 0.2%. That's it for Tuesday. We move now to Wednesday. Okay, so on Wednesday we had the CPI numbers coming from the UK and the Eurozone. So in the UK, we had the previous number at 3.8%. The forecast was 3.5, so uh, like lower inflation than the previous period. The actual came in higher than the forecast, so at 3.6, but it's still better than the previous number. So it means that the inflation is ticking down in the UK. Um, but like mainly this comes from the energy and food sectors. That's why it did not come in line with the forecast. It came in slightly higher. Um, but it gives the Bank of England room for cuts, but the services remain sticky at 4.5%. So that might cause some sticky inflation, as they call it. All right, then we had the Eurozone CPI. The previous was 2.2, the forecast was 2.1, and the actual came in line with expectations at 2.1 as well. What does that mean? It means that it's on target. It's ticking slightly lower towards the target of 2% inflation for the Eurozone. The the Eurozone is considered to have achieved their target of inflation, so 0.1% or 0.2% above the target, give or take, are not of a big deal. So they're almost at their target, um, which gives the ECB some room to cut rates if they want to boost the economy or to boost growth, which makes us think that we might see some rate cuts in 2026 coming from the ECB. All right, so how did that impact the markets? After this release, we saw the Euro stocks gaining 0.2%, the gold gained 0.1%. FX majors, mainly talking about the Euro USD, gained 0.2%, but it wasn't of high impact because it came in as expected. Now, as for the crude oil inventories, the previous reading was at 6.413 million barrels. The forecast was a shortage of 600,000 barrels, which is zero point 0.6 million. The actual came even the shortage was bigger than expected. It came in at minus 3.426 million barrels, which shows that demand is ticking up and supply is not keeping up with demand, which is a bullish sign for the oil prices in the US. So let's see how it impacted the markets. We saw energy stocks gaining 0.8%, the Dow gained 0.3%, the gold lost 0.2% on oil strength, and the USD gained 0.3%, while the euro lost 0.3%. Now that's it for the crude oil inventories. We had the FOMC meeting minutes. So those are the meeting minutes of their past meeting, when they cut 25 basis points on October 29th, if you remember. So what happened there? When we looked at the meeting minutes, we saw a divided Fed. Most of them backed 25 basis point cut, of course, because that's what happened. They cut 25 basis points, mainly because of job risks. The dot plot eyes one more cut by year end, but as we can see now, the markets are pricing in more than 60%, 67% chance that there will not be any rate cuts anymore this year. So that's pretty much it. We saw the divided Fed. We saw who voted for a no change, who voted for the cut, and who voted to cut even more than 25 base points, which was Miran, the guy hired by Trump. All right, so how did that impact the market? Nasdaq gained 0.5% on cut path, gold gained 0.4%, and the dollar lost 0.2%. That's it for Wednesday. Now let's move to Thursday. Okay, so what did we have on Thursday? On Thursday, we had the average hourly earnings, the monthly number, of course, coming from September. So this was the number that got delayed because of the government shutdown. But the numbers are coming from September because they only have the numbers for September. The whole month of October was off. They didn't collect any data. They didn't collect any numbers, so the data is lost forever. So the average hourly earnings for the month of September, the previous was 0.4%, the forecast was 0.3%. The actual came in lower than the forecast. So what does that mean? It means that it's cooler than expected. So the wage growth is slowing down, which eases inflation in some way. The S&P gained 0.4% after this release on dovish signal. The gold gained 0.3% and the USD lost 0.2%. Now, the initial jobless claims uh, for the latest or for that month, which was September, the latest week of September, the initial jobless claims were as follows. The previous was 228,000, the actual 220,000. So less people were claiming to be jobless in the US, which is a positive sign for the jobs market. The non-farm payrolls, however, the previous was minus 4,000. The forecast was 53,000 new jobs, but the actual came in at 119,000 new jobs in the US for the month of September, which is a very good sign for the jobs market. But don't get excited because let me read the rest of the calendar, because you will see that the unemployment rate was previously at 4.3, but it ticked up to 4.4%, which is exactly what the Fed does not want. They do not want the unemployment rate to um, jump higher or like start going higher and higher, because that's the one of the very early signs of a recession in any economy, that the unemployment rate starts creeping up and up. All right. So let's go back to the NFP and see how the market reacted there. Um, it was a big beat. So hiring rebounded sharply in September. And the Nasdaq gained 0.8%, the S&P gained 0.7%, and the gold lost 0.5% on strength. The USD gained 0.4%, while the euro lost 0.4%. Now, I forgot to tell you something about Wednesday, so the day before this. We had the earnings report of Nvidia. So Nvidia posted a great or a monster quarterly report, quarterly earnings report. It was above expectations, and the guidance was even stronger. They're expecting more revenues coming into the new quarter and even the new year, which is 2026. So there was a huge rebound in tech stocks um, after the Nvidia report or Nvidia earnings. But we saw that reverse on Friday, because the market is not only Nvidia. There are other AI names that are considered overvalued for the markets. So let's keep an eye on the tech sector and see what will happen. Now, moving back to the calendar, we saw that we had, okay, now we see we had Philadelphia Fed Manufacturing Index for November. So that's a fresh number. That's for this month, the current month. Previous was minus 12.8. The forecast was 1 point. The actual was minus 1.7. Now it's a lot better than the previous, but it's still in the minus, and it's still in the contraction territory. So it's less bad. Orders are up, but employment is weak. Now, what did that do to the markets? Industrials remained flat, gold gained 0.1%, and the USD stayed neutral after this release. Now, going back to what we were discussing earlier, which is the unemployment rate, it came in higher than the forecast and higher than the previous reading. So it ticked up slightly. More people are seeking work, but uh, they're not getting hired. They're seeking work, but the participation is at 62.4%, which is somehow low. Uh, how did that impact the markets? There was a mild offset to NFP rally. So after those releases, they got released at the exact same time. If you check the time here, all of them were released at 5:30 p.m. Dubai time. So there was a big spike after the markets saw the NFP. which was positive. But then they saw the unemployment rate, so that offset what happened with the NFP. So we saw a spike and then a pullback to the downside. Um, I'm talking about the US dollar, of course. Okay, so that's what happened. Next, we move to existing home sales. The previous reading was at 4.05 million. The forecast was an increase. The actual came in even higher than both at 4.1 instead of 4.08. So that's a good sign. It means that the sales are up 1.2% month over month. The median price is $415,000. And the first time buyers are 34% of the overall buyers. So, what did that do to the markets? The home builders stocks gained 0.5%, the gold remained flat, and the USD gained 0.1%. All right, now we move to Friday because that's it for Thursday. Okay, Friday we had the S&P Global Manufacturing PMI and the S&P Global Services PMI. So how did the market, or how did those numbers come out? The S&P Global Manufacturing PMI the actual number came in at 51.9. This one is not updated, but I have the numbers. So don't worry about that. 51.9 was the actual number, so it's slightly lower than the forecast. There was a slight miss, but we're still in the expansion territory. We're above 50, so we're good, which is a good sign for the US dollar, or a bullish sign for the US dollar. And we saw the US dollar gaining strength on Friday and breaking above a very important level, which was 100.4. Okay, and then we had the S&P Global Services PMI. This number came in at 55, so higher than the forecast, and higher than 50. So it's in the expansion territory, and at the same time, it beat forecast. So what does that mean for the markets? We saw a good rally in the USD after that release. We saw strength in the USD and the Dow Jones as well. So overall, the big picture this market was that we saw NFP numbers coming from September, and they beat, but the unemployment or the rise in unemployment rate for September causes a big stress for markets. So the Fed and the market participants, traders and investors, will be watching closely to see how does that impact the future of the interest rates in the US, and whether there will be a rate cut in December or not. So that's it for this week. I hope this was helpful. I hope it was light. It did not bore you. As always, trade responsibly, use stops, and I'll see you in the next one. Thank you for watching, and if you have any questions, please feel free to ask me in the comment section below. Take care of yourselves, and bye-bye.